Equity Market Update, July 2019. In July 2019, Indian equity markets corrected by nearly 5%, driven by concerns over domestic and global growth, FII outflows, and increasing trade tensions between the US and China. Mid and small cap indices corrected even more sharply. Large caps continue to outperform mid and small caps during FYTD 20. Most sectoral indices delivered negative returns on monthly basis. Auto, capital goods, metals, and oil and gas significantly underperformed, whereas IT, healthcare, and FMCG fared better. Performance of major global equity markets was mixed, with benchmark indices in United States, UK, and Japan ended the month slightly positive, whereas South Korea, Hong Kong, and Germany ended in negative. During the month, Brent crude prices corrected by approximately 2.1% and closed the month at $65.2 per barrel. Most major commodities prices moved in a range, except zinc, whose prices fell sharply. For FYTD 20, most major commodity prices have corrected significantly, except gold, which has risen on back of safe haven demand. INR was largely stable during the month and ended the month at 68.8 versus USD, up approximately 0.3% month-on-month. After being net buyers for 5 consecutive months, FPIs sold Indian equities worth $1.8 billion during July 2019. Total FPI's equity inflows in CYTD19 have been close to $9.5 billion as against outflow of $0.5 billion during the same period in CY18. Equity-oriented mutual funds inflows improved in June 2019. Net inflows in domestic equity-oriented mutual funds in June 2019 and CYTD19 were 57 billion rupees and 274 billion rupees respectively. Out of the Q1 FY20 results declared so far, cement, construction, and media were better than expectations, whereas banks, healthcare, consumer staples, and metals were largely in line with the expectations. Results for IT, auto, consumer durables, and industrials were below expectations. Nifty 50 is trading at price-to-earnings multiple of 18.8x based on FY20 estimated earnings and 15.7x based on FY21 estimated earnings. These are reasonable multiples, especially in view of improving profit growth outlook. Markets thus hold promise over the medium to long term in our opinion. With the sharp decline in mid-cap and small-cap stocks over the past 15 months, significant divergence with large caps is not likely going forward. Adverse global events, rise in crude oil prices, sharp moderation in equity-oriented mutual funds flows, delays in NPA resolution under NCLT are key risks in the near term. In view of these and expected recovery in earnings, there is merit in increasing allocation to equities in a phased manner or in staying invested as the case may be for those with a medium to long-term view and in line with individual risk appetite. Debt Market Update, July 2019. The 10-year benchmark Gsec yield ended the month of July at 6.37%, down by 51 basis points over the previous month end. Average interbanking liquidity was positive for the month due to higher central government spending and tepid growth in currency in circulation. Net FII debt inflows improved to $1.4 billion during the month compared to net inflows of $1.2 billion in June 2019. In the first 7 months of CY19, aggregate net FII debt inflows were close to $2.7 billion, as against outflows of $6.1 billion in the corresponding period a year ago. INR was largely stable during the month and ended the month at 68.8, a month-on-month appreciation of approximately 0.3% against USD. Annual rate of retail inflation, CPI, increased marginally to 3.18% in June 2019, up by only 13 basis points month-on-month, led by sequential rise in food prices. Fuel inflation was marginally lower than previous month. Core CPI inched up slightly on month-on-month to 4.72% on account of slight uptick in personal care, health and education services. India's trade deficit for June 2019 remained largely stable at $15.32 billion, primarily on account of higher net oil imports, set off by lower net gold imports. Further, the trade deficit increased slightly due to decline in exports of agriculture products, transport equipment and textiles, partially offset by lower imports of engineering goods, ores and minerals and chemicals. GST collection for the month of July 2019 stood to 1,021 billion rupees, approximately 4% higher than FY19 average monthly collection and up approximately 5.8% year-on-year. The average monthly collection required to meet the budgeted target for FY20 is estimated to be around 1,050 to 1,100 billion rupees per month. Outlook: Central government's discipline towards fiscal consolidation, with budgeted estimates of 3.3% of GDP for FY20, and plan to fund part of deficit by issuance of foreign currency denominated sovereign bonds, resulted in Gsec yields falling to 6.25% during the month, before ending at 6.37%. This was further supported by a rate cut of 25 basis points by US Federal Reserve. Going forward, interest rates are likely to remain range-bound with a downward bias. On the positive side, factors such as range-bound oil prices, high real yields in India, softening global commodity prices, easing stance by major global central banks, trade war tensions, and moderation of global growth favor lower interest rates. However, optimistic revenue assumptions posing risk of fiscal slippage, excess SLR within banking system, volatile FII flows, etc. might impact interest rates adversely. With the plan to raise a part of the borrowings in foreign currency and accommodative stance of RBI, there is some scope for policy rates to fall further by another 25 to 50 basis points. However, given the recent rally in Gsec yields and optimistic revenue assumptions resulting in risk of fiscal slippage, room for further decline in yields, in our opinion, is limited. Thus, in our assessment, the short to medium end of the yield curve offers better risk-adjusted returns. Hence, we continue to recommend investment in short to medium duration debt funds. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.